I want to walk you through a sequence of numbers that I have been sitting with for 3 days, not because the numbers are complicated, but because when you lay them side by side in the right order, what they describe is not a market under pressure. What they describe is a market approaching a structural impossibility, and the date that impossibility converges on is February 27th, 2026, 11 days from today. Let me show you exactly what the data says, where each number comes from, and why the mechanism that has contained every previous delivery crisis at COMEX is facing conditions in March 2026 that are categorically different from anything in the modern history of this exchange. Start with the inventory. COMEX operates a two-tier inventory classification system. Eligible silver is metal stored in COMEX-approved vaults that is owned by entities who have not yet made it available for contract delivery. Registered silver is metal that has been specifically warranted and made available for delivery against futures contracts. When a futures contract goes to delivery, the seller must provide registered silver. Eligible silver cannot fulfill a delivery obligation unless its owner specifically converts it to registered status and chooses to deliver it. In October 2025, COMEX registered silver inventory stood at 167.7 million ounces. As of early February 2026, that figure had fallen to approximately 103.5 million ounces. That is a 38% decline in just over 3 months. The drainage rate has accelerated to approximately 785,000 ounces per day. If that rate continues through February 27th, first notice day for March contracts, registered inventory will be approximately 85 million ounces when the March delivery clock starts, not theoretical, arithmetic. Now put that inventory figure next to the open interest number. As of early February, March 2026, COMEX silver open interest sat between 85,000 and 91,000 contracts. Each contract represents 5,000 ounces. Total paper claims against March delivery therefore represent between 425 million and 455 million ounces of silver, against 85 million ounces of registered physical. The ratio of paper claims to deliverable physical metal is between 5:1 and 5.4:1. That means for every ounce of silver currently registered and available for delivery at COMEX, there are more than 5 paper claims asserting the right to receive it. The standard response to this calculation, the one deployed every time it is raised, is that the vast majority of futures contracts never result in physical delivery. Most traders are speculators seeking price exposure, not entities that want to take possession of silver bars. They roll their contracts forward before first notice day. They cash, settle. The fractional reserve assumption of commodity futures markets has always been that the physical delivery demand will be a small fraction of total open interest, and COMEX has always been able to meet that small fraction without incident. That standard response was accurate for most of COMEX's history. The February 2026 data suggests it is no longer accurate. Here's the specific evidence. In January 2026, COMEX silver deliveries totaled 49.4 million ounces. That is 4.17 times January 2025's delivery level. It is 7.27 times January 2024's delivery level. January is historically the quietest delivery month of the year. It is a minor contract month with lower open interest than the active months of March, May, and July. And in January 2026, this historically minor month produced deliveries at more than 7 times its own 2-year prior level. That acceleration is not random. That is front-running. Market participants who know what is coming in March are securing physical silver early, before first notice day, before the delivery pressure concentrates. They are not waiting. They are pulling the delivery date forward because they do not trust the availability of metal at the scheduled delivery date. The February data confirms this reading. As of early February 2026, 18.72 million ounces had been called for delivery from February open interest of 19.11 million ounces. That is a 98% delivery rate. In a normally functioning futures market, delivery rates for minor contract months run between 5% and 15%. Speculators roll forward, hedgers cash settle. The 98% delivery rate in February means that almost every entity holding a February contract chose to take physical silver rather than roll forward or accept cash. That is not a futures market operating normally. That is a physical allocation mechanism. Entities that have the contractual right to demand silver are exercising that right at a rate that has no modern precedent in a minor contract month. Now put both of those data points together and understand what they tell you about March. January deliveries were 7.27 times their prior year level. February delivery rate is 98%. These are not independent signals. They are sequential data points describing the same behavior by the same category of actors. Entities with contractual rights to physical silver are demanding that silver at the earliest available opportunity, at rates that have no historical parallel, and in quantities that are systematically drawing down the registered inventory base that March's far larger open interest must be satisfied from. The total silver deliveries for all of 2025 were 474 million ounces, double the 203 million ounces delivered in all of 2024. Every single month in 2025 saw higher deliveries than the same month in 2024. This acceleration has been building for over a year. The January and February 2026 numbers are not an anomaly. They are the acceleration curve reaching its steepest point directly in front of the largest delivery month of the year. Here's the math that no mainstream financial outlet has assembled in one place with the actual current numbers. March 2026 open interest represents 425 to 455 million ounces in paper claims. By first notice day, registered inventory will be approximately 85 million ounces at current drainage rates. If March delivers at the same rate as January 2026, which was approximately 40% of available registered inventory in a single month, the math produces a shortfall before the end of the delivery period. If March delivers at the February 2026 rate of 98%, the shortfall is catastrophic and arrives within days of first notice day. Even at a historically elevated but not extreme delivery rate of 25%, which would represent 106 million ounces, COMEX would need more registered silver than will exist in vaults on February 27th. At 25% delivery rate against 429 million ounces of open interest, you need 107 million ounces. Registered inventory will be approximately 85 million ounces by that date at current drainage. The math does not work at 25%. At historical normal delivery rates of 5% to 15%, you need between 21 million and 64 million ounces, which is within range of what the vaults can supply. The critical question is therefore not whether COMEX can handle normal delivery demand. It can. The critical question is whether the delivery behavior of January and February, which is 7 times normal and 98% of available open interest respectively, represents a new behavioral baseline that will carry into March. Because if it does, COMEX does not have the metal. There is a specific detail in the open interest data that deserves direct examination because it is the most unusual signal in the entire data set. In January 2026, market participants began rolling their March futures contracts backward, not forward, backward. In a normal futures market, longs who want continued silver exposure but do not want physical delivery roll their contracts from the nearby month to the next active month. March longs roll to May. May longs roll to July. That forward roll is the standard behavior of speculators seeking price exposure without physical delivery obligations. In January 2026, the opposite happened. March silver futures open interest declined by 450 contracts in a single session. Of that 450 contract decline, 355 contracts rolled backward to January and February, the immediate delivery months. The January 2026 contract saw 170 new deliveries, while open interest actually increased by 135, meaning new contracts were being opened in January specifically to obtain earlier delivery. 1.775 million additional ounces moved into immediate delivery position from March. These are entities that cannot wait until March. They need the silver now, not in 2 months. When longs roll backward rather than forward, the explanation is not speculative repositioning. The explanation is physical urgency. They want the metal. They want it as soon as possible. And they are using the futures market's delivery mechanism as a physical procurement tool rather than a price speculation vehicle. This behavioral shift from futures as price speculation to futures as physical procurement is the single most consequential change in COMEX silver market structure in years. It changes the foundational assumption that makes the fractional reserve paper system functional. If most holders of futures contracts are seeking physical delivery rather than price exposure, then the fraction that historically resulted in delivery is no longer a small manageable percentage of open interest. It becomes a dominant majority of it. And when that majority exceeds the registered inventory available to satisfy it, the system faces a structural impossibility that cannot be resolved by rolling contracts, adjusting premiums, or deploying narrative management. It can only be resolved by sourcing more physical silver, invoking cash settlement, or force majeure, which is the exchange's contractual right to declare that physical delivery is impossible and substitute cash. Let me address cash settlement specifically because it is the primary tool cited whenever COMEX delivery pressure analysis is raised. The argument goes that COMEX has already built the cash settlement mechanism into its rulebook precisely to handle scenarios where physical delivery becomes impossible. Section 15.01 of the COMEX rulebook explicitly states that in the event physical delivery becomes impossible or impracticable, the exchange may settle contracts in cash at the prevailing market price. That mechanism exists. It has legal validity. And if invoked, it means that entities who held March contracts expecting physical silver would receive dollars instead of metal. That sounds like a clean resolution until you examine 3 things about how it actually functions. First, the cash settlement price would be the prevailing COMEX paper price at the time of invocation, not the physical market price, not the premium adjusted price that dealers are charging, the paper price that has been 15% to 25% below physical market prices throughout the recent correction. Entities that stood for delivery specifically because they needed physical silver and could not source it at reasonable premiums in the physical market would receive cash calculated at a price that does not reflect what physical silver actually costs to obtain. They would be receiving less money than the metal they were owed was worth on the physical market. That is not equivalent compensation. That is a forced wealth transfer from entities that contracted for physical delivery to the exchange and the short sellers who cannot fulfill their delivery obligations. Second, the invocation of cash settlement at COMEX would immediately destroy the credibility of the paper-silver market as a physical procurement mechanism. Every industrial user who relies on COMEX futures to hedge their silver procurement costs, every manufacturer who holds futures as a supply guarantee, every institutional investor who treats COMEX silver contracts as a claims on real metal would immediately understand that their paper claims are not reliable contracts for physical delivery. They are options that the exchange can convert to cash at its own discretion and at the paper price rather than the physical price whenever convenient. The revelation that COMEX silver paper is not a reliable claim on physical silver would do to silver derivatives what the London gold pool collapse in 1968 did to the dollar's gold peg. It would end the mechanism's credibility as a pricing institution. Markets that bypass COMEX entirely, with price discovery happening between buyers and sellers in direct physical transactions, would emerge. Some of this is already happening. Samsung C&T finalized a direct mining prepayment deal with Canada's Silverstorm Mining for exclusive purchase rights to 100% of the La Paria mine's silver output for 2 years. Tesla and other technology manufacturers are securing silver through direct supply agreements with mining companies rather than relying on exchange delivery. When the world's largest industrial users stop relying on the exchange and go direct to the mine, they are already pricing in the exchange's delivery unreliability. The cash settlement scenario would accelerate that structural shift dramatically and permanently. Third, the cascading effect on subsequent contract months. If March experiences delivery stress and partial or full cash settlement, every entity planning to stand for delivery in May receives an immediate signal. The May open interest, which represents the next concentrated delivery period, would immediately see an acceleration of the same behavior that drove January and February. May would become March before March's delivery period closed, and July would become May before May closed. Sequential delivery stress cascading through the contract calendar would drain credibility from the entire future strip and force a repricing of every month's open interest to reflect the true physical scarcity that the paper price has been suppressing. Let me also address the eligible inventory argument, because it is the most sophisticated counter-argument available. COMEX eligible silver, metal stored in vaults but not yet warranted for delivery, is substantially larger than registered silver. If eligible holders choose to convert their metal to registered status and deliver it into March contracts, the supply available for delivery increases significantly. That is theoretically available silver. The reason it matters is that eligible holders have chosen not to convert. They are sitting on that metal, watching the drainage of registered inventory, watching the delivery rates accelerate, watching the paper price trade 15% to 25% below physical market premiums, and they are choosing not to deliver into paper contracts at those prices. Eligible metal converts to registered when the price offered by the futures market is attractive to the eligible holder. When physical market prices are higher than futures delivery prices, eligible holders have a direct financial incentive to sell on the physical market rather than convert to registered and deliver into COMEX. Every day that physical premiums hold above COMEX spot, eligible holders have more incentive to supply physical buyers directly and less incentive to convert and deliver to COMEX. The eligible inventory exists, but the price signals are pointing its owners away from COMEX and toward direct physical sales. That is not a supply source that reliably backstops the registered inventory decline. Here's the complete picture assembled from every documented data point. Registered inventory fell from 167.7 million ounces in October 2025 to approximately 103.5 million ounces in early February 2026, a 38% decline in 3 months. Drainage rate of 785,000 ounces per day means first notice day arrives with approximately 85 million ounces available. March open interest represents 425 to 455 million ounces in paper claims. February delivery rate is 98% of open interest, the highest ever recorded for a minor contract month. January deliveries were 7.27 times January 2024's level. Contracts are rolling backward rather than forward, meaning entities want earlier delivery, not later. Samsung, Tesla, and other major industrial users are bypassing COMEX entirely through direct mining agreements. Physical premiums are 15% to 25% above COMEX spot, meaning eligible holders have financial incentive to sell direct rather than convert and deliver. Cash settlement exists as an emergency mechanism, but invokes it destroys exchange credibility and cascades into subsequent contract months. February 27th is 11 days from today. Every number in this analysis updates daily on the CME Group website. Registered silver inventory figures are posted publicly. Open interest data is published daily. Delivery notices are archived in CME Group performance reports, going back to the beginning of modern COMEX silver trading. Nothing in this analysis requires access to proprietary data or non-public information. Everything here is available to anyone who goes to the CME Group website and reads the numbers rather than the headlines. The numbers in the headlines are telling you very different things about what is approaching on February 27th, 11 days. The data is public. The math is arithmetic. What happens next is either the most consequential delivery period in modern COMEX history or the most consequential deployment of cash settlement and force majeure in modern COMEX history. Both of those outcomes are historic. Only one of them reflects the paper price. The other reflects what the physical market has been saying all along.